All right, everybody, welcome back to the Strategic Acquisition Workshop, or the 4-day live virtual multifamily workshop. This is day 2. Today, we are going to talk about analysis. Yesterday, we discussed acquisitions, but we did not really cover any underwriting. We're going to lightly touch on a little bit of underwriting today because part of analysis is financial analysis. We're not going to do a deep dive into underwriting, but we will spend a moment or two in it because it is part of the due diligence process, along with 3 other major legs of due diligence that I will talk about. So, where are we today? If we remember yesterday, we talked about the strategic acquisition system. We have our 3 phases: acquisition, analysis, and operations. Yesterday, we did acquisitions. We started with begin at the end in mind. Then we talked about finding off-market opportunities, and we went into 6 alternative ways to try and close a deal that just isn't a standard method. Today, we are covering analysis, so we're going to talk about due diligence initially, property management, and then the capital stack. Really, today, we're going to touch on capital raising. We're not necessarily going to talk about finding a lender or preferred equity or anything like that. It's going to be on raising capital. So this is where we are today. Tomorrow, I'll have Charles Seaman with me, and we're going to talk about asset management, project management, and exiting the deal, which is covered under operations. So we're going to talk about the strategic analysis model. That is a CCIM model that I teach in CI 102. We're going to go over that model, and that model is due diligence. If you do everything within the strategic analysis model, you have completed a full due diligence package, and you cannot go wrong. You will be able to come to your go, no-go decision. Let me mute this. My wife knows I'm teaching, and she's still texting me. Come on, volume, get with me here. There we go. And that is now off. Next, we're going to talk about hiring a property management company because that is something we do during the analysis period if you do not already have an operating partner. And we're going to take a deep dive into that. And I'm going to provide those that are VIPs with the property management questionnaire. It's 49 questions you can interview a property management company with. As a matter of fact, I've already emailed all the VIPs the property management questionnaire, the questions investors ask questionnaire, and the due diligence resources. So hopefully all the VIPs got that this morning. Then we'll talk about getting the money. Again, it's going to be more on capital raising than getting a loan or finding other alternative loan structures. It's really going to be about capital raising for that part. Then we'll look at some action steps and get into a little bit of Q&A at the end, as we did yesterday. I believe we can fit this in time. There shouldn't be too much that I have to get into during this. It just depends on your questions as we go through. So we should finish this on time, which will give us quite a bit of time at the end for Q&A. I do have a hard stop at 2 p.m. Eastern time. All right, let's talk about the strategic analysis model, which in effect is due diligence. And I think you will agree with this as we look at this. So the strategic analysis model, I look at it like a stool. So this is a seat of a stool. We have to start with our goals and objectives. We've got to come up with some alternatives, put our decision criteria together so that we can come to no-go decision points. And I'm going to hit each one of these individually. Then the 4 legs of the stool are the due diligence process: market and competitive analysis, location and site analysis, political and legal analysis, and financial analysis. And we're going to talk about each one of these individually. So on our stool, and if you knock any leg out of the stool, so if you don't do your marketing competitive analysis, well, if you don't do that, then you don't have your inputs for your financial analysis. So you've pretty much screwed yourself already. But if you don't do the political and legal, or you don't visit the property, and I've known a few not to do that, then you are missing a leg of the stool. And what happens? The stool falls over and you're setting yourself up for disaster. So make sure you complete all 4 phases. So on our seat, we had goals and objectives. So now we're just trying to determine what are our goals for the market that we're entering, what are our company goals, and what are the property goals that we're trying to achieve. Then we have to look at alternatives. Are we looking at different asset classes? If we're a little opportunistic, are we doing Class C value add or Class B Class B cash flowing, a cash flowing Class B asset? Here I go brain farting again already today. Yesterday I had an excuse. Today I have no excuse. Or is it property types? Okay, it could be a conventional apartment market rent versus a low income. It just depends on what your alternatives are. You have to determine that. And then your decision criteria. This is your key performance indicators, or KPIs. This is your discount rate, your equity multiple, your internal rate of return target, which is the same as your discount rate. And that then gets settled with your goals and objectives. And now you have everything you need to come to a go, no go decision after you complete your analysis of the 4 steps. So if discount rate eludes you and you don't understand what that is, because trust me, there is not a guru in this industry that teaches it, because they don't understand it. Okay, it's why I talk about fundamental underwriting. Discount rate is the rate, is your risk. How do you determine your risk? Well, if I'm going to whoop out 100 grand out of my pocket and I'm going to invest it in a deal, I want a return for that deal. That's my discount rate. Institutions utilize their weighted average cost of capital as their discount rate. That's the absolute lowest IRR that they can go. Your discount, when your discount rate and your internal rate of return are the same. So if I have a 15% discount rate based on my risk, and the internal rate of the return on the property looks like it's going to be 15%, that means my net present value is 0. Oh, crap, there's another word you guys have probably never heard before. Okay. Net present value, what that does is it discounts your future cash flows at your discount rate to today's value. It tells you, based on these cash flows, how much I can pay for the property. So to put it in David Lindahl terms, it gives you your strike price. So if your net present value is positive, meaning that the internal rate of return was higher than your discount rate, then you can add that to the purchase price and still get your target IRR. That can make you competitive. If the discount rate is lower, or I'm sorry, if the internal rate of return is lower than your discount rate, then your net present value is going to be negative. You must subtract that amount from the purchase price, and this becomes your strike price for purchasing the property to achieve your desired internal rate of return. I teach all of this in the underwriting fundamentals workshop. Okay, so if you don't have access to that, just email me. Let's talk about it. Okay, so again, that gets us to the go, no go decision. I had to throw in that. I'm sorry for going off in the weeds, but I'm on a mission to teach everybody what discount rate and net present value is, because it is key in understanding fundamental underwriting principles. Sorry, I'm a little passionate about it. Okay, so our go, no go decision. Are we going to purchase? Are we going to retrade? Or are we going to cancel the contract? Now, there are people out there that will teach you to retrade. You will ruin your reputation if you do that. Do not go into a contract with the intention that you're going to retrade it, meaning you're going to ask for a different price. Okay. So if you didn't visit the property and you're just trying to be competitive and you want to win the best and final and you put some stupid number out there and then you go and visit the property and say, well, this wasn't what was advertised. I want $2 million off or I'm not closing. You will ruin your reputation really, really fast. Do not be that person. There are times where you'll go to a property and there will be things that were not mentioned, some things the owner may not even know. Usually there's structural problems with the buildings. And then it is appropriate to have that discussion and renegotiate the purchase price. But do not enter a contract with the intent to retrade it. That is unethical and you will ruin your reputation. So, what is the definition of strategic analysis? It's the overall process by which we determine whether the market will support a particular use. Doesn't matter if it's multifamily, self-storage, retail, industrial, office, it's irrelevant, single family. It will support a particular use at a particular site so that it is profitable. So we have to determine whether the use that is on that site is profitable. And that's where the strategic analysis model comes in and due diligence. So the real estate decision must meet 4 feasibility tests. And these 4 feasibility tests are the 4 legs of our stool. It must meet market and competitive feasibility, location and site feasibility, political and legal feasibility, and financial feasibility. Okay. So market and competitive analysis. This could be on the market, so your overall local economic area, your metro statistical area, the market. Submarket could be a county or a subset of that metro statistical area. And then your trade area delineation. This is where the direct competition comes from. We need to look at each one of these. When we look at employment, we're looking at the overall market. Then we can drill down to the submarket. We could start to look at some demographics in the submarket, and then we get into our actual rent comps and the direct competition that is right within that trade area. Okay, so you can have multiple employment centers in a market, but your employment center that your residents are magnetized to or wherever they work, there could be a few different trade areas around that employment center, which would be located in a submarket of that major market. All right. So we have to identify all of this in the market and competitive analysis. We got to look at demand and supply and see if there's demand in the market or if there is oversupply in the market. And you may think there's demand because 200-300 people a day are moving to the market. But if the market is overpriced, then what happens is the residents will roommate up or they'll move in with their parents or their siblings. Point is, that population is not correlating to the demand because the market is overpriced. This is what we're seeing in a lot of markets. So we look at the analytics and we can see what the renter's demand is by looking at the absorption of units per the amount of units that are being delivered to the market. So if you're looking at a market and the occupancy is decreasing, that means that your renters have said, we can no longer afford this market and we're going to move in with each other, even though we know there's people moving to the market. So don't just assume because there's population growth that there's demand. You have to look at all the numbers. Okay. A course that I teach and is on my YouTube channel is called the Due Diligence Workshop. I go into how to do these in a little bit more detail. I also have another one called the Emerging Market Workshop. That one is not on YouTube because there's a lot of personal information and forms and stuff that YouTube will not allow you to put on. But email me. I'll get you access to either of those. Economic base analysis. Okay, this is a term you're probably not familiar with. This is where we look at the employment in the market and we can actually determine future population by putting math to the equation. All right, economic base analysis, it's simple, but it is not easy and it is really hard to understand. But once you understand it, you cannot fail. This will tell you what the future employment is of the market over the next couple of years based on data that we can pull from Bureau of Labor Statistics, which means we can then put a population employment ratio to that future employment and predict what future population is going to be. Once we know what future population is, we can then determine future demand and supply for our market. Then there's shift share analysis. Shift share analysis is the analysis of a market where we look at the amount of employment moving to the market and the amount of employment moving away from the market. There are a lot more factors involved in shift share that I'm not going to go into here. Again, I teach it in that emerging markets workshop, and we teach it in CI 102. So if you guys want to know all this information for all the different asset classes, meaning retail, industrial, office, and residential, which is apartments, then I would recommend taking CI 102, which is what I teach for the Institute. Shift share, I kind of go high level. I provide you with a resource so that you can determine where the competition or where you're competitive in a market, which we can consider to be a comparative advantage. Comparative advantage is a market that specializes in a certain type of employment. Like Austin, somebody jump in. I know we got some people from Texas. What is Austin's primary employment focus? What are they known for? There you go. Ben says tech. Good. What about where I live in Mobile, Alabama? Does anybody know what Mobile specializes in? Manufacturing. What about Charlotte? I know I got a couple of North Carolina folks here. What is Charlotte? Irish crawfish. Banking. Good, Ben. That's exactly right. Banking. Okay. So these markets, we know they specialize. Well, comparative advantage, what it does is it shows that a market that specializes and doesn't try to be a generalist, they specialize on one or two, three things, depending on the size of the market, and that facilitates trade with other markets that have specialties that they don't have. And then those markets where they specialize, they won't have specialties in what the other market does. And what that does is it facilitates trade. And that's how this economy works. Our national and global economy is currently shifting around or constantly shifting around because of a comparative advantage. And shift share will show us where a market has comparative advantage. That is just a really high level explanation. But as you guys can see with what I'm talking about, if you don't understand any of this or you've never taken any courses on any of this, then you are not properly doing a market analysis when you are looking at your properties. Then there's market cycle identification. I think everybody here that's followed me on YouTube knows how to look at a market cycle chart by now, considering I have the rent analytic reports from all the different markets early in 2023 before CoStar put the kibosh on that and told me to stop. You'll see exactly how I determine how to plot a market on a market cycle chart and what the definitions. I've got a video on the YouTube channel on how to identify the real estate market cycle, how to explain it, okay? And in much more detail than anybody else. I actually give you the definitions of each phase as well as the problem that sits during that phase and the solution on what you can do in that phase, all right? Again, I didn't make any of that up. That is what the CCIM Institute teaches and what 135 universities across the country teach in their MBA programs. Fundamental principles. That's marketing competitive analysis. Now, you're going to see it again, but I'm going to say it a million times. The outputs of your market and competitive analysis become the inputs for your financial analysis. So if you are not doing a proper market and competitive analysis, you don't have the right information that you're inputting into your pro forma. Okay? Do not sit at your desk and think you can do your due diligence. It's impossible. You can get a lot of data from it, but you got to go prove that data by walking the market. Okay? I'll just leave it at that. So, oh wow, CoStar did, yeah. No, CoStar, they like their data. They don't like you sharing it. So it is what it is, Wayne. All right, so location and site. Now we're physically inspecting the property. This is the physical inspection of property and trade area. Again, that trade area is the area around the subject property that is the direct competition, not 2, 3, 4, 5 miles away like the broker's going to give you on his offering memorandum. There you go, Richard, which is designed to get you to believe that the rents are higher than they should be. Okay. So typically we will draw that trade area by what's called a Thiessen polygon on a map, and it will be defined by functional boundaries, meaning physical boundaries like an interstate, a railroad, a major highway, a major road, a river, an ocean, a mountain. All of these boundaries will draw out what your trade area looks like. If you get an OM and you've got a comp that is 5 miles away from your subject property, take that OM, crumple it up, throw it in the trash, do the same thing digitally. It's worthless. All right. You've got to identify your own rent comps. Do not rely on brokers. On-site inspection of all units. Now, I'm going to preface this. If you are not under contract, and if I'm brokering a deal, and you come to me and you received my offering memorandum or my NDA in an e-blast, and you come to me and say, I'd like to inspect the property, I'd be like, okay, when are you available? Well, we're available Tuesday, Wednesday, and Thursday of next week. I'm like, oh, okay, which day? Oh, we're going to need all 3 days. Excuse me? Well, yeah, we want to see all the units. Nope, that's not going to happen. I will show you one unit of each unit mix, and they will be vacant. If I do not have a vacant unit in that unit mix, then I will show a occupied unit with the permission of the resident. If the resident says no, I will ask another resident. We do not bother residents pre-due diligence. Okay. You're doing some of your due diligence in the beginning, especially when you have to do a non-refundable deposit. I get it when it was competitive. I understand. But you are not going to be given access, and do not ask access for all the units before you ever even put an offer in. It's not going to happen. They're not going to do it. Okay. Just a little preface there. But once you are under contract, you are going to physically walk I don't care if there's 1,000 units on that property, schedule the entire week out. You are going to walk all 1,000 units. Do not hire a company that will do a property condition assessment, because that property condition assessment is only going to consist of 10% of the units. So they're only going to do 100 units of 1,000. That is not due diligence. You need to put your eyes, or your direct team, not third party, your direct team needs to put eyes on every single unit. Am I clear about that? Do you guys understand this? I
Hey,
see.
David,
Yeah, go ahead.
quick question for you. So, is there an ethical boundary or limit to the type of due diligence we perform before we go under contract? So, say for instance, if I was walking a property with me and my team and we had a vacant unit that we were wanting to assess, and we wanted to take a look at, some of the components of that property or that particular unit. Is that above and beyond? Is that too much to ask for before we go under contract, or should that be saved for after we decide to move forward?
So you should never walk a property without getting permission from, if it's being brokered, the broker.
Hmm.
Uh, if it's not being brokered, the owner. They will
Okay.
schedule with the property manager to show you the units that you request. What I always asked for was, I want to see the good, the bad, and the ugly. And I don't care how. I want to see your best. I want to see your best model unit. I want to see an average unit that is ready to lease, that might be functionally obsolete, and I want to see one that's down to the studs if you've got one. I want to
Hmm.
see the worst, I want to see the best, and I want to see something in between.
Mm.
And
Okay.
I want to see at least one of each of the unit mix types if they're available. Sometimes they may not be available.
Hmm.
If they are available, all right, that is your ethical boundary. Once you're in a unit, if the unit is vacant, do not unscrew anything. You can open cabinets, you can look in showers, uh, you can take pictures, you can do everything you want to do to be able to satisfy your team. If you're in a occupied unit, you got to be very careful. Do not take pictures of general areas. You could take pictures of mechanicals, you could take pictures of under sinks, but be very, very respectful to the residents.
Hmm.
Don't open a closet and take a picture of the closet. You're not looking at cleanliness. You can do that during due diligence. During due diligence, when you're using your interior due diligence inspection form, you can write down how big of a slob that the resident is, because especially if you start to see bugs and things like that, because maybe when you're doing your lease analysis, we see when that lease expires, and that unit can then become a target for renovation, because that's a resident we probably don't want to keep. So
Hmm.
you can make
Hmm.
notes like that during due diligence, not during the pre-offer phase. Okay?
Okay.
Make
All right.
sense?
Yes. Thanks.
Awesome. Sorry to pound that, but I see too often, and as a broker, I would get requests to see all units, and I just flat tell them, no, it ain't happening. Not going to do it. Okay? Next, when you're done checking your property, walk the comps. You could choose your comps on CoStar or Moody's Analytics or um, Axiometrics or Yardi Matrix or any of the tools that you use to determine your comps. Walk the comps you selected. Okay. There's a couple of reasons for this. You are going to want to determine, and we're going to talk about this when we get into the project management plan, but you're going to want to determine what level of renovation the market is looking for. You do not want to I'm sure you guys have heard this. You do not want to over renovate. If you over renovate, you are overspending and you're not going to get the additional rent. The exception to that is if we're at the very bottom of the market, everything is functionally obsolete, kind of like it was in 2009, 2010, and you wanted to upgrade the units. That is the exception. But if we're in a part of a market cycle where we're in now, where about 80% of all properties have been upgraded, go figure out what the upgrades are and what the rents those properties are achieving. Because the manager, when they let you tour, and you can do it one of two ways, you can either say, we're purchasing this property. We identified your property is as an amazing community. We'd really love to be able to improve the entire neighborhood by building a community much like you guys have. Is it okay if we see some of your model units? They'll agree to that sometimes. Sometimes they won't. You can also go in as a potential renter. Now, if you're like me and you're an old white guy, and you're in a lower income area and the area is mostly African American or mostly Hispanic, you're probably not going to be able to go in as a renter. So you're just going to have to use your empathy and try to get the property manager to show you their units because you want to improve the entire neighborhood or that submarket. Does that make sense to you guys? But you've got to walk the comps. Ask if you can take pictures. Sometimes they'll let you, sometimes they won't. All right. And this is also going to help your summary when you have to send your summary to the lender, that you walk those comps, that you have pictures, that you've got the flyers and their brochures for their rents, and that you compared it with exactly what your business plan is on your property. Now we got to start identifying issues. These can be structural versus cosmetic. Again, if a piece of linoleum is peeled up in the corner and you know you're replacing it anyway on your renovation plan, do not retrade the price. Okay. If there's dirt in the corner or if you've got some peeling paint on the windowsill, all right, you've already identified in your pre-inspection most of these items to determine what your renovation budget's going to be. You're going to make it a solid plan once you do your physical due diligence. Let's see. Can you pay the proper? No. Peter, do not rely on third party. Your team walks the comps. Do not trust. You can use the word trust, but verify. Okay. Trust CoStar's data, but verify that data by you walking the comps. If you guys want to be successful in this business, you're going to have to do some work. This is not a push button business. Take the time to learn the market that you are investing in, especially if you have investors. If I was investing in a deal as a passive investor and I found out that the sponsor did not walk the comps, I'd blow a gasket and I'd let every single one of the passive investors know. I meant pay the comps property man. Still don't understand what you're asking, Peter, if I'm misunderstanding. I'm gonna keep going. I'll keep watching the text. All right, so now
Uh,
we want to go ahead.
David,
Yep.
sorry, let me clarify that. I meant to go to Com's building and then approach the property manager and say, hey, if they're not willing to do that, maybe pay them $50, $100
Oh
to,
yeah, if that'll work. I mean, I've never
yeah.
tried that. I've never been told no.
All right, appreciate it. Thank
Yeah,
you.
yeah, I've never been told no. So I guess that could be something that you could do. All right, identifying structural issues. Again, cosmetic, we don't care. All right. We want to note cosmetic issues. We want to note cleanliness of the resident. We want to note bugs and pests, but we only are focusing right now on structural. So if you are walking the unit and it feels a little cattywampus, you're like, something just isn't right here. Take a golf ball with you or a tennis ball. Tennis ball will roll on carpet better than a golf ball will if there's carpet in the unit. Set it on the floor and see if it stays there or see if it moves. If the tennis ball or the golf ball moves, you have a settling building. You've got foundation problems. Okay. Walk outside, look at the exterior. If it's siding on the exterior, is the siding buckling in certain places? Or if you look at the foundation itself, whether it's sitting on tiers and piers or whether it's on a slab or whatever type of foundation it may have, does it look like there's cracks and structural issues down where that tennis ball or golf ball is rolling? Look at the roof. A lot of times, what'll happen is a an owner will identify a sagging foundation and they'll lift the building, which is something you can do to fix it. They'll lift the building. They won't properly repair the foundation, but what happens is it buckles the sheathing on the roof. And you can see it by the shingles on the roof buckling. If you see that, then you know you had a previous repair. And if you still have that ball rolling, you still know you've got a structural issue. That is major. Now we're retrading the property. Okay. You're talking a lot of dollars to fix this. This is not something you were told about. You can get into legalese later about disclosures and everything else. I wouldn't really worry about any of that. Let your brokers worry about that kind of stuff. But now you've identified something that may be worth retrading. All right. Does that make sense? That's the kind of issues you're looking for. Something else that you want to look for, and we saw this on a property locally, a 64 unit, is you'll see after a rainy day, if you can get on a property right after it rains or while it's raining, you can see where the water's pulling up. This shows drainage issues. I've got one property, my very first property I ever listed, that 34 unit. It had sewage issues. So when it would rain, the toilets would back up and overflow with sewage in one of the buildings. You have to identify these kind of things, and you can see it from mud that will kind of line the building where you won't see it anywhere else. So you know you have drainage problems if you start seeing stuff like that. All right, there you go. I'll buy that, James. Lease analysis. All those notes that you're taking while you're walking the interior. This is going to help you determine your renovation plan, because there are going to be some residents you're going to want to keep, even if you can't take them to market rent. Don't fall into that trap. Heads in beds. Heads in a bed means you have rent coming in. If you don't, you don't have rent coming in. When the rent isn't coming in, your net operating income is going down, not up. Okay. Heads in beds. That's number one priority. So when you look at your lease analysis, you're going to want to determine through the inspection of the interior who had immaculate apartments, who was really friendly. And while you're walking your units, you are welcome to speak to the residents. Even if the owner says no, even if the property manager says no, doesn't matter. You have that right. You have equitable interest in this deal because you put consideration down and you have it under contract. You are authorized to do your due diligence. If you piss them off, it is what it is. Okay. You're under contract. Now, that owner cannot get out of contract because you spoke to the residents. You could sue that owner for specific performance. Okay. That is not a reason to get out of a contract. What are they trying to hide? All right. So, yes, you may talk to the residents under due diligence. Do not talk to residents pre-due diligence, pre-offer. Okay. That's what due diligence is for. Do not talk to the residents. If you talk to the residents prior to putting the deal under contract, you're probably not going to win the deal, even if you're the only one bidding on it. They will just say, nope, this guy was too much of a pain in the butt, or this gal did not do what we asked them to do. We aren't selling to them. And they have that right. Okay. But once you're under contract, you're able to do that. Identify linkages. That's the employment center. That's a linkage. Another linkage is a grocery store, a convenience store, a transportation, a public transportation stop, like a rail station or a bus station, something like that, or a bus stop. These are public transportation areas that are linkages. Daycare facilities, restaurants, these are all linkages for residents. You want to identify what is attractive to the target resident that you are trying to lease to, and are those linkages within the area for that resident. The number one, even today, number one linkage Most important. Does anybody know what it is? And if you've been following me at all, you already know what my answer is going to be. What's number one? Number one importance to a resident. No, it's not grocery store, Andrew. It is important. It's not number one. Bank, major road. Nope, 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 not job. Okay. Be more specific on jobs, John.
Jobs.
Yeah, Susan, be more specific on jobs. What specifically?
Decent paying jobs.
Location. There you go, Nick. You got it. How far are they from work? When I was a career renter, I've only owned 3 homes in my entire life. Current one I'm in now and 2 others. I was a career apartment dweller. Probably why I love apartments so much. My number one criteria for renting was how close can I be to work? Okay. How close can I be to work? Number one. Number two was then price. Number three started to go to amenities, and then I would start going to linkages. Now, if kids are involved, as important as how close to work can you be, are you in a proper school district? Okay. That's if kids are involved. So you've got to take that into consideration as well. But when we're talking about identifying linkages, that's what we're talking about. Oh, lost my technology there. There we go. Okay, so this is employment, transportation, grocery, schools, etc. Now we got to create and we got to verify that renovation plan. All right, so all of the inspections that we've done, we've recorded everything. We've done an exterior inspection and wrote all the problems that we've seen, all the good stuff we liked. We've done our interior inspection. We've noted everything in the interior inspection, including location of fire extinguishers, smoke detectors, carbon monoxide detectors if there's gas on the property, the HVAC units, the water heaters and their age, take pictures of their data plates. What I like to do is I like to walk up to the unit and I take a picture of the door with the number on it so I knew what unit it was. And then all the pictures that I took belong to that unit. Then I knew that the next door that I took a picture of, that ended the pictures for the previous unit and started the pictures for the new unit. And instead of having to sit there and just write down model numbers and serial numbers and ages of the HVAC and the hot water heaters, I take pictures of the data plate and I could write those things down later. All right. Saves a little bit of time. So hopefully that'll help for you guys. All right. So remote work is being brought up in the chat when we're talking about linkages. So an exception to finding an apartment close to work would be Silicon Valley. You do not want to live in Santa Clara County if you don't have to, unless you're making high 6 figures a year. It is the most expensive place next to San Francisco and New York City to live. Santa Clara County, which is the South Bay, 35 miles south of San Francisco. Used to live there, grew up there. You cannot afford to live there if you have anywhere plus or minus, say, 100K a year. That's just not enough money. So if you can get remote work with Google, although you're probably going to make more than that at Google, I'm just using it as an example, and Google will allow you to do remote work, then you're going to want to live across the mountain over in the Central Valley in somewhere like Livermore, or maybe even Pleasanton, Dublin, places like that in the East Bay. It's a lot more affordable to live there than it is to live in Silicon Valley. So that would be an exception. Yeah, Richard, Sunnyvale. So junior high, I lived in Sunnyvale, went to Peterson Junior High. If you're older than I am, then it may have been Peterson High School at the time. In 1983, it switched to a junior high. And then I should have gone to Wilcox from Peterson, but I moved to Santa Clara from Sunnyvale and ended up going to Santa Clara High School, which prior to 1984, in 1983, it switched to from Buxer High School to Santa Clara High School, and then Buxer became the junior high. I yeah, I love Mountain View. One of the first breweries, microbrews, and I know we're a little off topic here, but it is what it is. One of the first microbrews that had over 100 taps was in Mountain View, had 135 taps. I don't remember. I think it was off of De Anza Boulevard, if I remember right, but I cannot remember what it was called. Gotcha, Richard. All right, let's keep going. Any questions about physical or location and site analysis? All right, political and legal. And I am taking a long time on this, but it is what it is. Number one, does the property have a certificate of occupancy? Ask the owner, ask the management company. If it does not, go to the city and ask the city. Do not close on the property without a certificate of occupancy. You do not want to make this your problem. This is the owner's problem. Make it their problem. Get a copy of the certificate of occupancy before you close on the property. Zoning variance. So if there was a variance on the property, let's say you're purchasing a what are these things called? Pad splits. You guys heard about pad splits? There's a company out there that is an app, and they have investors purchase homes in residential neighborhoods that then modify the inside of these homes to be like group homes. That violates zoning when you do that. If you are purchasing one of these buildings, you are going to want to go to the, and trust me, you're going to piss the owner off if they have not done this, but it is what it is. You do not want this problem. You're going to ask the owner, do you have a variance for a group home? Because it's zone residential, single family residential. Do you have a variance for a group home? If they tell you no, you must go to the city and request a variance. Say you're purchasing this property. Here is the address. Will I be able to get a variance for this situation? More than likely, it's not going to happen. Okay, not with these pad splits. I'm using an extreme example. Something a little more less extreme would be if you, and there was one available here for a long time in Mobile, Alabama off Michigan Boulevard. There was a 12-unit home that did have a group home variance, but it was in really bad shape. So here's the problem with the variance. The moment you open a wall or you file for a permit, the city can force you to bring it to zoning compliance and lose your variance. The other thing is if you're changing the use. So if you're going from a single family home to a group home type deal and you request a variance, the city can force you, and under the International Building Code of 2012 and higher, you will be required to bring the building up to current building code standards. So you got to be careful doing zoning changes and variance. If it's ground up development, zoning changes all day long. Request it, takes a while for it to get approved or declined. Do not close on the property until that zoning change is done. What you do is you do a land contract and you put it under option for a little while so that you have the option to get out of it if you can't get that zoning change. That gives you more time than a standard contract. But variances are very dangerous. Be very, very careful of them. Yeah, well, you got that right, Richard. Violations and citations. We bought a property in Longview, Texas. And first thing we did, because there was a lot of deferred maintenance on this property, and we could see that there were busted banisters and things like that on the stairs, and there was a second story, and some of the iron railing was broken. So we're like, we ought to go down to the city and see if there are any violations or citations on this building. Oh boy, did we find out there were all kinds of citations on this thing. So we requested a meeting with the Zoning and Planning Commission and their team to see what they would like to see on this property. And we took their input and built it into our renovation plan. And we took an absolute eyesore on the south side of Longview, right on High Street. And we made a property that residents would have been proud to stay in. And the city was happy for everything we did. And it was really easy for us to get permits and things like that because they knew we were trying to improve that neighborhood. So you may think that going and checking violations and citations is a bad thing. You can churn it into a good thing. Building code requirements, that falls right back with variance. If you open a wall, you're required to have a permit. Be careful what you ask for, because when the inspector comes out and checks, and I'm going to use an example on a 60 unit we owned here in Mobile. We took all of the tub surrounds out, which opened the walls around the tub surrounds because they didn't put proper sheetrock behind it. And we put in tile on the walls for the tubs and the bathrooms of this 60 unit apartment complex. City came out to inspect and said, you can't use that right there. Does anybody know what they pointed to? In the tub, they said, you cannot use that. You have to bring that up to code. Does anybody know what it was? Okay. You know your, no, it wasn't the iron pipes. So, you know your valves that you turn your water on with? On older apartments, 60s, 70s, 80s, you had 3 knob valves. You remember when you would flush the toilet, it would scold you. You guys remember that? In older homes or older apartments, you flush the toilet. If someone's taking a shower, it would scold them. Okay. That's because where those valves go in for the piping, that's called a diverter valve. And the older diverter valves, what they would do is, depending on your hot and cold that you selected, you were getting the full heat from the hot water heater. So if your hot water heater was set to 120 degrees or 140 degrees, you would get, if you had no cold and all hot, you'd get all 140 degrees, boiling your skin, although that's not boiling, but burning your skin in your shower. The new diverter valves that came out, and I can't remember when they came out. I think they came out in the 90s or early 2000s, the single valve diverter valves. They came with a temperature regulator. So now, today, if you're in a more modern home or a more modern apartment, you flush the toilet, you don't get scolded anymore. And it's because these diverter valves have a temperature control. So when you'd flush the toilet on the old ones, the cold water would stop going to the shower head and would be rerouted to the toilet to fill the toilet back up. And that's why you'd get scolded on the old diverter valves. So if you opened a wall in your bathroom and you had to get a permit, the city required we replaced all 60 diverter valves in our unit at $350 a piece. It was not something we anticipated we had to do, but you learn from your mistakes. So hopefully you guys can learn from that The point is, when you are pulling a permit, be very careful because you're probably going to have to bring what you're doing up to building code standards, current building codes. Covenants, conditions, and restrictions are restrictions that were put on by the developer. If there is a CCNR or there is a homeowners association or condo association or anything like that, review those documents so you know what you're getting into. All right. Landlord resident friendly. We all understand this. Do you want to invest in a landlord friendly state, a resident friendly state? That's just part of your political and legal analysis. I don't have to go deep into that. Landlord tenant laws drive that part of the analysis. Is the market business friendly? You can learn this by getting a copy of the master plan. Almost every single market in the country has a website. On their website will be some kind of master plan. They may call it something different, but there is a future plan. McKinney, Texas calls it their 2040 plan. So by 2040, this is what they would like to see. All right. It's one of the best master plans I've ever seen. We like to tease everybody and say a CCIM must have wrote it because it is so good. But you want to take a look at that master plan and see where the city's wanting to invest. You may be able to get some tax abatements, things like that. These are things you can learn from that master plan. All right. Any questions on political and legal? All right. I went way into the weeds on this and I didn't want to, but I felt it necessary. I do this. Those of you that know me know I do this. I go a little crazy sometimes. All right, financial analysis. And I've said this a couple of times already. The outputs from your marketing competitive analysis become your inputs from your financial analysis. Okay. So what are we looking for? We're looking for market rent versus actual rent. Okay. So if you get an OM and you receive a T12, what is considered market rent? What's considered market rent? Is it what the broker puts on the OM for the highest rent in the market? Or is it Sri, you got it. Or is it the highest rent that you can achieve for that unit mix on the T12? What do you guys think? Yeah, it's on the T12. Okay. That is considered your potential rental income, your PRI, which is at the top of your APOD, annual property operating data. Again, that's CCIM term. Okay. So we want to determine market rent versus what the actual rent is. If we are given potential rental income, which is what the property could achieve 100% rented with all the units at market rent, then what do we need to get to our gross rental income? Come on, we got 58 people in here. I know there's more people than me that do underwriting. What do we need to get from potential rental income to gross operate to net rental income? Yeah, loss to lease and vacancy. Okay, our vacancy assumptions must have them. Okay, both loss to lease and vacancy, physical vacancy and loss to lease. All right, we need them both, including your no payers and your slow payers. Okay, we need all this information. Those are our vacancy assumptions. And when we look at our vacancy assumptions, the most important is year one. Okay, we want to determine the day we take over the property. What is it right now? What is it today? So the day that I close on this deal, am I going to cash flow in the first month or not? That's what's most important, especially today in the market cycle. That is a fundamental principle. We got to look at income growth. What are you guys putting for income growth? Where are you going to get income growth, first of all? Where are you going to go to get your income growth?
Bureau of Labor and Statistics.
Not Bureau of Labor Statistics. That'll show employment growth. It won't show income growth. It will show how much money the employee is making. It'll show that income growth for wage. It'll show wage growth. It will not show your income growth for your property. When I talk about income growth, I'm talking about if I'm getting $1,200 a month for rent in the day I take over the property, what is the percentage I believe the property can grow over the next 3 to 5 years? That's income growth. Where do we get that number? Ben, I've never heard of either one of those two, and I'm assuming OnStar means CoStar. I have no idea who Rently is. Okay, you guys need to use a data analytic company, not a listing exchange. So if Rently is a listing exchange like apartments.com, you should not be using apartments.com. You should not be using Rent-A-Meter. You should not be using any listing exchange for determining rent growth or for determining rent comps. You got to use CoStar, Moody's Analytics, Yardi Matrix, Axiometrics, any of these other data providers that provide analytic rental data. In CoStar, we can go back and look at the last 20 years and see what the rents were on this property. We can look at it quarter over quarter. So we can look and see, is the property growing quarter over quarter, year over year, or is it stagnant, or is it declining? And I'm going to use that data to determine my income growth. Okay. Yeah, I figured it was CoStar. Do not use apartments.com, Rent-A-Meter, or any of these listing exchanges. You will set yourself up for failure doing so. They are only asking rents. You want to see effective rent. Okay. And you want to be able to see history. You're not going to get history with those resources. Expense growth. What are you guys doing for expense growth? This is our little bit in underwriting that we're covering. I'm sorry, I didn't hear that.
I'm sorry, I mean P&L.
Well, yeah, we're going to use our expenses on the P&L, but how are we growing our expenses? What is our assumption? Where do we think expenses are going to grow? At what rate? Same for historical, but also look at CPI. Yeah, okay, good. So when do you never? Who asked that? Mario, love you. George, you never ask for estoppels. So George Estrada, good friend of mine out of Southern California, he's an office guy. George, you're going to ask for estoppels in office. In multifamily, we aren't paying an attorney to do what we can do in our own lease analysis. 3% or inflation, says Tim. Inflation budget, etc. Same. Okay, so you guys are on the right path here. And Mario hit the nail on the head because he knows, he's listened to my underwriting workshop. He understands where I'm going with this. I don't care if you put 12% for income growth, put 12% for expense growth. I don't care. Robert says 5%. Robert, if you put 5% expense growth, put 5% for income growth. Why? Why would I do that? Greg, what you're talking about is normalizing the T12, and that is absolutely something you want to do. But why do you guys think that I want income and expense growth to be the same? I don't care what the market is. I don't care if you use 3%, 5%, 100%. Doesn't matter.
Well, I don't think you want I don't think you want your expenses to outgrow your income coming in, which is going to leave you less profits, hopefully.
What if they are?
Then you got to figure out how to exit the deal or to bump rent by adding value or something along those lines.
Here's my point, Garth. When we make them the same, we're not manipulating the model. So when you see these syndicators, sponsors, put all this junk information into these financial models, they'll put 5% for income growth and they'll put 3% for expense growth. What do you think that does to your pro forma? If you look at your pro forma on a bar chart, what does it look like? It goes up and to the right. Okay. Juices the returns, inflates the NOI. Everybody's saying the same thing. When you use the same, because we can't predict what our income's going to be, we can't predict what our expenses are going to be. Changes all the time. Market conditions change all of this. Federal government changes all of this. Insurance companies change all of this. States change all of this. Okay. Utility companies change all of this at a whim with no indication it's going to change. So what do? If we take income and expense and we make it the same, we're not manipulating the model. We are being as transparent as we possibly can. Okay, so let me look at this. Hold on, I'm back to the chat. So David, can't you utilize these other rent places like apartments.com to see if there's an oversupply? No, you don't get oversupply information from that, Ben. You have no supply side data at all on apartments.com. It just shows you how many apartments are for rent. Do you know what the total number of units in the market is? Does apartments.com give you that? Does it tell you how many are under construction? Does it tell you how many were delivered in the last 12 months? Does it tell you how many were absorbed from what was delivered? Doesn't give you any of that information. And that is all absolute information you have to have in order to underwrite. Okay. Sorry, guys. I know I'm being aggressive on this, but it is mind-boggling to me. People that are buying 300 to 500 unit apartment complexes that don't know how to underwrite, that don't take any of this that we're talking about into consideration. It's just mind-boggling to me, but is what it is. It's why I do what I do. All right. And why I don't charge 30 grand to do it. Let's keep going. Reversion. This is your exit cap rate, the refi cap rate, your cap rate when you go to sell the property. How do we determine what in the world that's going to be? Whether it's 2 years, 3 years, 5 years, 7 years, 10 years. How in the world do we know what that's going to be? It's required on the financial model. How do we know what to put there?
That when you add a certain amount of basis points per year up until you
Good luck
exit.
with that, Wayne. Good luck with that. I bet that's worked really well for all these idiots that bought since 2021.
Trend standard.
Long-term oh, Ben, you're talking my language. Yeah, let's look at some long-term historicals. But with where we are right now, what is most important that we want to look at when determining exit cap rate? What's caused all of these properties that purchased at 3.25% interest to be negative cash flow? Interest rate. That's right. Okay, Fed fund rate, that affects interest rate. So if interest rates are currently at Freddie Mac last Thursday is 6.6%. So we'll just use 6.6. If interest rates for a 30-year fixed, if it takes you 6.6% to get a 30-year fixed, can we use that number to start to calculate what our exit cap will be? Or does it matter? Okay. That's a rule of thumb, Robert, and I am not a rule of thumb guy. I use data. Yes, Ben, of course you will. So everybody seems to believe. Well, let me just ask this question. You guys see it in the news. I don't watch the news personally. All I do is take a look at headlines so I can keep abreast as to what's going on. There is this belief interest rates are going to go down in 2024. I would like to know what everybody believes. So the Fed fund rate today is 5.5. What will the Fed fund rate be at the end of this year? December 31st, 2024, what's the Fed fund rate going to be? Yeah, I got you, Robert. I'm with you. I just want to see what everybody thinks. Put it in the chat. I want everybody here. There are 59 people here and me, so 58 people. 5.25, 5.5. Okay, so same down a quarter, 5.25, 6 higher, 5.5, don't know, 6, 5.75. All right, so you guys all believe it's going to be around the same, maybe 25 basis points lower, maybe 25 basis points higher. I'm with every one of you. Thank you so much for that belief. So what is that going to do to interest rates for a loan by the end of 2024? Well, to put it in Jim Rohn terms, not much, right? Probably about where they are now. Does anybody know what the long-term interest rate is? The long-term Fed fund rate. The 52-year long-term Fed fund rate over 52 years. That's when Freddie Mac started tracking the Fed fund rate. 52 years. What is the Fed fund rate? What is the average?
There's your little kitty.
Susan, mute your line, please. Okay. You guys are thinking the actual interest rate, but the Fed fund rate's 5.73. That is the long-term average. It might be 5.33. That's the long-term average. Yeah, since 1980. Okay. So why do we, and we're right now, we are at the long-term average. So why do we believe interest rates are going to go down? Why is that belief hitting the marketplace? It boggles my mind. No racism. So my point on this is, unless we have a major market crash like we had in 2008, forget the election year, it doesn't matter, Ben. Unless we have a major market crash, the Fed fund rate's going to stay, well, the interest rates are going to stay about where they are right now. Okay? Somewhere between 6 and 8%. We're at 6.6 right now with Freddie Mac. And they're going to stay this way for a while, maybe 4, 5, 6 years. They'll fluctuate like they do all the time. 10 years been going up and down. It's currently over 4%. A week ago, it was 3.8%. Okay. Constantly fluctuate. It was almost 5% 2 months ago. Okay. That's the market doing what the market is supposed to do in a free market society. That 10-year moving up and down, which affects interest rates. So 5 years from now, what would we anticipate the interest rate being? Not knowing what the government's going to do, not knowing whether Trump gets elected again or not knowing any of this crap. What do we believe 5 years from now interest rates will be? Or what data tells us interest rates will be 5 years from now? Peter says, I don't know, I'm just going to put 5 to 12%. Plan for the worst, hope for it's less. Okay, about the same, about the same, about the same, about the same. So I think if you're using somewhere between 6 and 8%, you're good. So let's just go to that minimum 6%. Okay. So what does the cap rate need to be In order to have positive leverage, if my interest rate is 6% 5 years from today, what does my cap rate need to be in order for me to purchase with positive leverage? Ben says greater than 6%. Ding, 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 ding. That is absolutely correct. Greater than 6%. At 6%, it's neutral leverage. Under 6%, it is negative leverage. What does that mean? Well, I'll tell you. Positive leverage. Oh, so why do you get a loan? Does anybody know why we actually get a loan as real estate investors? It's the same reason we raise capital, for leverage. That's right, George. We do it for leverage, so we don't have to use our own money. Okay? We lose the ability to have leverage when the cost to purchase the property is more than the cost to operate, or when the cost to operate the property is more than the cost to purchase the property. What the hell do I mean by that? Your cap rate is the cost to purchase the property. That's your cost on cash flows. That's your cap rate. The cost to operate the property is the interest rate on your loan. Okay? When the cost to operate the property is higher than the cost to purchase the property, you've lost leverage. That cost must be lower to operate than the cost to purchase. Okay, I hope that makes sense. You would be better off paying cash to get a higher internal rate of return than if you were to have negative leverage. So these people buying still at a 4, 3.5, 4, 5 cap when they're getting a loan at 6 to 8 to 9%, they are reducing the amount of return they're going to get on this asset. Hopefully, they're being transparent with their investors about doing so. My guess is they don't even know it's occurring. That's just a guess because they have not been taught proper fundamentals. I am spending way too much time on this, but that's how important this is. All right, so George, for you, because your office, it needs to be above 2. You cannot get a loan in office today unless you have 2 DSCR or higher, debt service coverage ratio. For multifamily, it's still about 1.25, 1.3. And if your debt coverage ratio is a 1.3 at acquisition, you can get a 75% LTV, no matter what anybody's telling you in the market. The reason you're getting a 55% is because you don't know how to underwrite and you're negative cash flow or you're below a 1.3 DSCR. So what the lender does is they give you the minimum of DSCR or loan to value. So if you want a 75% loan to value, but your cash flows don't support it, then they're going to give you the loan to value based on the minimum debt coverage ratio so that you at least cash flow at acquisition, at least should cash flow at acquisition. Okay. Garth, have to leave the meeting, but we'll continue. Okay. Roger that, Garth. No biggie, bud. All right. We got to keep going. Everybody understand reversion cap rate? The reason I'm pounding so hard on it is because it is the number one way to manipulate your model. Just a minor move, 10, 15, 20 basis points can change, depending on the size of the property, can change the value of the property in millions. All right, we just talked about positive, neutral, and negative leverage. Break-even occupancy. Does anybody know what break-even occupancy is? Break-even occupancy is the point at which your occupancy level gives you the same net operating income as your debt service. It's correct. Occupancy that supports debt service. 100%, Mario. Okay. Yeah. Zero cash flow, Peter. Exactly. That's break-even occupancy. Why do we need to know break-even occupancy? And Sri just said it. Minimum required occupancy to service the debt. You're still going to be in trouble by your lender. You got to be over break-even occupancy, but at least you know as you enter a recession what that break-even occupancy is so that you don't go below it. Beds and heads. Beds and heads. Heads and beds. Okay. Heads on pillows. That's all that matters in a recession. The number of heads on the number of pillows, period. Okay. Stay above that break-even occupancy. And why do we need to know operating expense ratio? What can that give us? Break-even occupancy could be a test, testing your cash flows. So certain properties are going to operate at a certain operating expense ratio based on whatever their rents are. Prior to 2018, the last analysis I did in Mobile, Alabama, which is a lower rent market, the operating expense ratio for Class C properties that were built in the before the 1980s was for 100 plus units was 48%. That was the operating expense. That was the average. I looked at hundreds of T12s. The average operating expense ratio was 48%. If the owner was paying water or any of the utilities and they weren't doing rubs or anything else, it was higher. Okay. As rents increased, the operating expense ratio decreased, but guess what also increased faster than the rents did? Expenses. So that hasn't changed much, even with where we are on high rents. Now, in the Midwest, it may be a little different. Your operating expenses are not escalating at the same rate operating expenses are escalating on the Gulf Coast and in the East Coast counties, the coastal counties. Insurance has driven operating expenses through the roof if you're on the coast. Okay. Yes, because of insurance, Ben. So, or property tax coupled with insurance in Texas. So the Midwest would be a little different. As your rents increased, your operating expense ratios went down. So instead of being 48, you might have been at 42, 43. Under no circumstance are you ever going to take a Class C 1970s built property to a 35% operating expense ratio. The number one management company on the planet is Greystar. Nobody beats them. They own more properties than any other company in the world by double the number two group. Okay. These people know how to operate a property. When they build brand spanking new and deliver day one, they're delivering at 35% operating expense ratio. How in the hell are you going to take a Class C property and operate it at 35%? I don't care what kind of renovations you do, and not be Greystar. Anyone? Anybody got an answer to that? That's why I use operating expense ratio as a test. If you get a T12 and a pro forma, and in year 2 or 3, whenever your business plan is supposed to be completed, and you have an operating expense ratio below 40% on a Class C property, crumple it up, throw it in the garbage, because that's what it is. It is garbage. I'm raising the BS flag right now. There it is. Big old red flag right up the flagpole. All right. It is a test. That's the reason I mentioned that. Any questions about financial analysis? And was my rant helpful? And I apologize for the rant, but I get passionate sometimes. All right. Yes, helpful, most helpful, excellent. Thank you, guys. Thanks. Appreciate it.
David, on the best, most pristine job for a Class C property, what would you expect for that operating expense ratio to be?
Depends on the rents.
Best case.
Depends on the market, depends on the rents. Your best pristine job. Now, did you take it to the studs? Did you knock it completely down and rebuild it? Because remember, you're putting lipstick on a pig. I don't care how beautiful it looks.
Yeah.
You're putting lipstick on a pig, because guess what? You still have 1970s wiring. You still have 1970s plumbing. You still have 1970s ducting for your HVAC. You still have 1970s rafters. Okay. The internal structure of the building, the foundation, is still 1970s construction. You can't change that unless you knock it down. That is the reason. You're still going to get deferred maintenance. The age, just the age of all this stuff, your HVAC system is going to bleed condensation. Your plumbing is going to leak. You're going to have water issues. You're going to have electrical issues. Okay? Residents, Ben. Residents. We don't have tenant. Well, he said renters, but I like to say residents. I don't say tenants. I say residents. It's just a mind shift. Okay. Finally, we move into step 2, an hour and a half into this. I said I thought we'd get it in 2 hours. Guess what? It ain't happening. Hope you guys are enjoying this. But I feel that George still have 1970s termites. That's exactly right. Or if you live on the Gulf Coast, Formosan, which get up in your soffits. Hiring a property management company. Now, before we do that, we're finishing due diligence. There is a due diligence checklist for that. I created this due diligence checklist. Notice financial analysis, market analysis, location site analysis, political and legal analysis. It is all there. Okay. Oh, we're getting ready to interview a property management company. Okay. Here's some information about that. Okay. Date scheduled, interview dates, date completed, what the cost was on all this stuff. Okay. I created this. This is mine, 100% me based on the strategic analysis model. Prior to closing, what are all the things we need? And we'll talk about this when we get to tomorrow. And then what do we do after closing? All right. So this is the most comprehensive. We even talk about hiring employees or contractors. Okay. This is the most comprehensive due diligence checklist you will ever find. Ever, I would argue. And all you have to do is ask me for it. Honestly, go to my YouTube channel, go to the due diligence workshop, and you can get all these resources for due diligence. All right. But what we're going to talk about now is property management. Okay. So I emailed this to all the VIPs, which are 49 questions you can ask a property management company, either on site or off site. Okay. While I have this up, because we're going to get into capital raising at the end of this, if we still have time, hopefully. Questions investors ask when you are raising capital. Okay. Now, caveat to this, and you'll see that, is I took a lot of these from Joe Fairless's book, Best Ever Syndication Book. He has a section in there on questions investors will ask. It's the most comprehensive list of questions I've ever seen. I added a few and I took a few away that I thought were obsolete. So this is mostly Joe with me mixed in it a little bit based on the capital raising I've done in the past. So these are our 3 documents for today, and these have already been emailed to all the VIPs. Okay. Let's talk about hiring a property management company. We're looking for the right operating partner. So if you have intentions of building a multifamily company, you want to own thousands of units and have hundreds of employees around the country or in a region or in a few markets, then you need to find an operating partner. That's how we should be looking at our property management company, that we are creating a strategic partner with us, an operating partner. One of the things I always like to do was I would ask the management companies that I interviewed, and it's on the questionnaire, do you invest in the opportunities that you manage? Why would that be important? Why would I even ask that question? Why would I want the management company investing in a deal that they're managing with me? Why does that matter? Skin in the game. Ben hit it right on the head. Now they have a reason, a why to do the right thing. Okay. So if you can find an operating partner that will invest with you, and a lot of times what I saw with a lot of management companies, including my own, when I owned my management company, we like to invest about 10% of the deal. So whatever the equity raise is, we want to put 10% in. And we want to be given the opportunity to manage the asset for our management company as a third party contract for putting that money in. It does not guarantee we can stay the management company, though. For God's sakes, make sure there's a firing clause, even if they invest in the deal. Okay. Still doesn't mean they'll do the right thing. Yeah, absolutely, Ben, 100%. But Make sure they're putting money in. Don't just now, if it's Graystar, look, we know Graystar is going to do the right thing. Again, best management. Well, number one property, I'm not saying best, number one property management company just by the number of units they own. I would say the best management company, but they don't do third party anymore, is McKinley. McKinley Property Group used to be out of Detroit. Now they're out of Orlando. That is the best property management company I've ever seen. And Albert Barras, who is the CEO, is one of the nicest men I've ever talked to in this industry. They are a family-run company, and they are doing the right thing. But again, they're not third party anymore. But they will invest in opportunities to become that operating partner. What happens to their 10% interest? It stays. It stays in the deal. Okay. And you need to say that in the management agreement. All right. So offsite. This is for offsite management. Now, for a lot of the Southeast smaller markets, this is going to be about below 70 units. I say market dependent because it depends on rents. Your NOI. Your NOI has to support on-site management if you're going to have on-site management. Smaller properties usually don't support it. Now, there are states that require that there is an on-site manager, like California. Who knows what the requirement is for an on-site manager? What's the minimum units that an on-site manager is required? In California. No, Gwen. No, George. Yes, Mario. Was that Mario? No, not 100. Anna, 16. It's correct. Susan said 16. That's right. 16 is the minimum. So the rents, not necessarily 20, 30 years ago when this rule came into effect, did the rent support 16 units. So what they did was they just hired a super, kind of like they do in New York City for co-ops and the different buildings they have in New York City. You'd have a super. They did the same thing in California for anything over 16 units. Today, you could support an entire staff with the rents they get in California, at least in the bigger cities, LA, Orange County, Santa Clara County, San Francisco, San Diego. You can support those rents at 16 units. The rest of the state, it's just a super. So we're below 70 units, again, market dependent. What are the manager's responsibilities? Well, you have to define that. And what you're looking for is for them to tell you what the off-site manager's responsibilities are going to be. Is that manager going to visit the property every day? Is somebody from the management company going to visit the property every day? Okay, how are they handling leasing? And we're going to go through a bunch of these. But you've got to determine whether what they'll do supports what you're looking for. And what you're going to have to be careful of, and we'll talk about this on another slide, is what fees are they charging you in addition to your management fee. Now, while I'm talking about, and I'll wait till I get to fees. All right, maintenance responsibilities, same thing. The management company will have a maintenance staff for their portfolio of properties that they manage off-site. What constitutes when a maintenance person will go to the property, or an assistant maintenance person? What type of emergency call do they have? Okay, we need to identify these. So if there's a major water leak, not a drip, but a major water leak at 2 o'clock in the morning, who answers the phone? And will maintenance go out at that time? And are there additional fees associated with it? How are they leasing? Is there a special leasing agent? Are they getting a percentage for every apartment that they lease? Are there bonuses for those leasing agents, and who's responsible for what? Okay, these are all things, and we'll get into it a little bit more detail, but what you really want to know is how are they incentivized? And you can control this from your management agreement. What you never, ever, ever, ever want to do is incentivize for lease extensions. Why? Why would you not give a bonus for a lease extension or renewing a lease? I'm sorry, new leases, not lease extensions, for new leases. We never give bonuses or incentivize new leases. Why? I just gave you kind of the answer. Yeah, turnover. It increases turnover. Because if you incentivize them to write a new lease, they'll never renew a lease. So you do want to incentivize them for renewals. You never incentivize them for new leases. What's the exception to that? When do we incentivize new leases?
When you should do renovations, I guess.
As soon as you finish renovation, that's right, that initial lease from renovations or from new build, like John just said. That's exactly right. Good job. Perfect. Okay, contractors and vendors. Who hires them? Who's responsible for them? Who signs the contracts? How are they paid? And what are their terms? Project management services. Do they offer them? If this is a value add, does the offsite management company offer project management services? And we're going to go deep into project management tomorrow. Okay, so not today, but tomorrow we're going to go deep into, because that's part of operations. So do they offer project management services? What you don't ever want to do, and I learned this the hard way on the deal we did in Texas, in Longview, you do not want your property manager to also be your project manager. Why? Why do you not want that to happen? It can be the same management company, but you don't want it to be the same person. Anybody want to know why? Can't do both. Well, they probably can, Ben, but they're going to do one better than the other. They're going to specialize in one or the other. Okay, not their expertise. Yeah, you guys hit the nail on the head. You want the expert to be in that position. You want your property manager that has a CAM or a CPM or something like that to be your manager. And you want your project manager to maybe have a PMP or maybe, which is a professional or project management professional. It's just a certification you can get as a project manager. I thought about getting a PMP one day, but that went by the wayside. Or a general contractor's license or some kind of contractor's license, whatever that might be. Okay. That's their specialty. Property managers, that's their specialty. Let the project managers do their thing. Let the property managers do their thing. What you want to make sure is that they communicate back and forth on a consistent basis and that you're getting that information. That's what matters the most. All right, for on-site, it's really the same thing, only now we're adding a manager or managers on the site. So who's responsible for hiring that manager? Can you have decision authority in hiring that manager? Remember, you're hiring a management company. They're not your employee. They're the management company's employee. Can you be in the interview? Okay. Do not fret over not being able to have decision on whether they hire the manager or not. Again, it's not your company, okay? You're just hiring them as a third party to manage your property. Now, if they're an operating partner, it could be a little different. They may give you some input. They may not take your input into consideration, but they will give you some input. But at least you want to be in the meeting as they're hiring this person for the asset that you control and own. Same thing with maintenance. Okay. Who hires maintenance? Obviously, it's going to be the management company, unless you're hiring a third-party maintenance company, which would not be typical for on-site. Now, if you are self-managing, which never, ever, 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 ever recommend, you are the ones hiring for these positions. Okay. For maintenance, what certifications do they have? What licenses do they have? All right. We're going to cover some other things like bonds and insurance and stuff like that later, but these are all things you have to question and see. Leasing. Is the manager responsible for leasing, or is there an assistant manager that does leasing, or is there a separate leasing person that gets paid based on the number of leases that they either renew or bring into the apartment complex? Okay, these are questions you need to get answered. Same with contractors and vendors. All right. And then, of course, again, project management services. Now, if they are a good management company and this is a larger property, say over 70 units, I would require a management plan. If I'm hiring the company, I want a management plan. If it's an off-site management company and they do some apartments, but they don't focus on apartments, they focus on single family, or they're a commercial brokerage and have management services, and their management services focuses on commercial management but has apartment management also, you may or may not get a management plan. I wouldn't require it for smaller properties, but for bigger properties with on-site personnel, I would find an operating partner that will provide a management plan. All right. Especially if their regional or their principal is a CPM, a certified property manager. They know how to do a management plan because it's required by the Institute of Real Estate Management in order to get that certification. If you can find a company that is a CMO, a certified management organization by the Institute of Real Estate Management, that is an even bigger bonus. All right. They're probably going to be a little bit more pricey, but it'll be worth it because they absolutely know what to do. Okay. And they will absolutely give you a management plan. So, what's in the management plan? Well, it's a summary of the business plan you discuss when you're hiring the management company. You want to see summarized what you have discussed. You want to see their budget. You also want to know that they'll work with you on the underwriting of the property that you're purchasing and provide a budget even prior to closing on the deal so that you can lock your underwriting down a little bit better based on what they believe their budget can be. And then any future opportunities, if they want future to build that operating partner with you and manage future opportunities with you, to do the same thing, provide budgets for them, which includes rents, vacancy, credit loss, other income, operating expenses, typical APOD, okay, and capital expenses. Leasing strategy. What is their leasing strategy? You want to know for new leases. Again, we go right back to incentivizing. We don't incentivize for new leases on just standard turnover. We do incentivize on new leases when a apartment has just been renovated or the initial lease up from development. What's their online strategy? What is their print strategy? What is their retention plan? Okay, and again, we want renewals. We don't want turnover. We want renewals. Exception is your renovation plan. There are going to be some units you want to turn over. How are you going to handle that turnover? Are you going to move the tenants or residents to another unit, or are you going to make it difficult for that resident so that they move out? Okay, and you can just do that by increasing the rent by an exorbitant amount, but not going higher than the highest rent in the market. Let me see, we got a question here. Would you hire a property management company that also owns properties near your property? I've heard two sides to this story. It's honestly, it's up to you. Could there be conflict of interest there? If you both have 4 units vacant, which one are they going to rent first, theirs or yours? It really comes down to the residents. I think property management companies, they all want to do the right thing. And unless they're building a real family culture like McKinley does within their company, I'm not sure your leasing agents are even going to be aware of the difference between your property versus other properties that they own. So you just got to play that by ear, Peter. I mean, that's the best advice I can give. Yeah, that's it. That's exactly right. All right, reporting. How often do you want reporting? Do you want it monthly? You want it quarterly? I think weekly is too much, but I would caveat that with if you are in a renovation schedule and a project management plan is currently underway for renovations, you want reporting weekly. And then incentives, and we've talked about those. Preventative maintenance. Has anybody here owned a multifamily property and did not have a preventative maintenance plan in place? An actual system, a preventative maintenance system in place? Good Lord, are we behind schedule? Okay. This is probably the most important part of the entire management plan. When I managed our 60 unit that we owned in Mobile, when I had my management company, we put together probably one of the best preventative maintenance plans we had ever devised. There were 60 units. There are 3 months in a quarter. There are 5 days in a week. There are typically 4 weeks in a month, but you've got 1 month that has 5 weeks. You basically have 13 weeks in a quarter. So what we did was we devised a preventative maintenance plan based on the calendar. We had a one maintenance guy and an assistant. The assistant was part-time. So on a monthly basis, and we had 60 units. So all he had to do was do, what was it? 15 units a week, 3 units a day. Okay. He'd go in and he'd change the filters in the HVAC. He'd inspect all of the smoke detectors. Didn't have gas on the property, so we didn't have carbon monoxide detectors. He would open the cabinets and look at the plumbing, make sure there were no leaks, no drips. He'd inspect the fire extinguisher and sign the card on the fire extinguisher, which is required by OSHA. And just ask the resident anything he needed to be aware of at the time. That was our monthly preventative maintenance. On a quarterly basis, okay, so now we just divided the 60 units up over the quarter. He would go out and put the charging mechanism on the HVAC to make sure the HVAC was charged. He would point his little temperature gun at the inlet for HVAC in the unit and at the outlet and make sure that there was at least a 15-degree change, because at their least efficient, an HVAC should bring the temperature down 15 degrees. Or within 15 degrees, sorry, inside the unit. What else did we do quarterly? That was it, quarterly. Then annually, he would check all the dates on, he would verify all the dates on the water heaters and HVAC units. He would charge the HVAC units. And he would do the hydrostatic inspection for all the fire extinguishers. And that's what we did on an annual basis. So the preventative maintenance plan was on the calendar. And in addition to his other duties, he knew he had to do these things. And we just spread it out, and it was very easy for him to do. And then the property manager just managed that schedule, and it worked really well. Okay. So you want to have a preventative maintenance plan. Bank accounts. Who's responsible for them? Is the property management company going to have the bank accounts, or are you going to have the bank accounts? It is okay to have the property management company have the bank accounts for the operating account and the escrow account for the deposits. Keep them separate. But you must be a signer on the accounts, because if you fire the property management company and they don't do the right thing, how are you going to get access to your money? Okay, you must be a signer on the account as an owner of the property. Evictions. Who handles them? Who's responsible for them? Whose attorney is it? Is it their attorney? Is it your attorney? Capital expenses. How is it handled? Is there a capital expense account that is handled by the management company, or is it handled by ownership? It depends on who's responsible for project management. Experience. How much apartment experience do they have in the market? Do they have other, if it's a 140 unit apartment complex, do they manage other 100 plus unit apartment complexes? If they're a 30 unit, if it's a 30 unit apartment complex, do they have other similar apartment complexes that they manage, or is it all just single family? Qualifying residents is beyond the scope of what we're doing here, George. But there are multiple ways you can qualify residents. The National Apartment Association provides one of the best resources for doing that. And then TransUnion, which is one of the credit reporting agencies, they also provide a free resource for doing credit checks as well as background checks at a minimal cost for apartment owners. And then the team. Who's on their team? Who's the property manager? Who's the regional manager? Who's the principal of the company? Can you call the property manager as the owner? A lot of companies won't allow you to do that. I'm not sure that's a good thing. Who is your point of contact? And then if you can't get a hold of the point of contact, can you call the property manager? Personally, I want to have access to that property manager, because when Freddie Mac walks onto the property, which is my lender, and asks the property manager, when's the last time you talked to the owner? If the management company has not allowed you to talk to the property manager, Freddie Mac's not going to get a very good feeling about your management company right off the bat, or you. Initially, it's going to be you. Oh, well, that means the owner's never been to the property. Whoops. That's a bad juju. You don't want that to happen. Now you're getting blacklisted from Fannie and Freddie. Fees. Management fees. What do you guys think you should pay for off-site management? Base fee. Off-site management. Off-site. Not on-site. Off-site. Peter says 6. Peter's in New York, so that may be applicable to New York City. Mel says 8. Thea says 10. George 10. Ben. Oh, you're fired. Ben and Mel, you're both fired. Wayne 10. Andrew, you're fired. Okay, here's the deal. How well do you want them to operate your property? You want them to do a good job? Do you want them to do a 10% job, or do you want them to do a 4% job? George says, I want them to do a 15% job. That's right. Okay. Do you guys know the industry that has lower margins than restaurants? Off-site property management companies. There's virtually no margins in it. Okay. If you want them to do the right thing and not nickel and dime you, pay 10%. I owned a management company. I'm telling you this from my heart. If you try to nickel and dime me down to 8% and I accept the deal, or 6%, or God forbid, I wouldn't take 4%. That's just stupid. I wouldn't go below 8, be honest with you, but you're going to get an 8% worth of my time. If I'm asking 10%, give them 10%. They ask 8%, be glad to pay 8%. Okay? There's no margins. And if you want them to do the right thing, you've got to pay them. Mel, it just depends on the budget. They have to do what they say they can do. Okay? And the fee has to work in your financial analysis. All right? So what I would do is, if it's a smaller property that is going to have an offsite management company, I would underwrite it to 10%. So, Andrew, I wouldn't take consideration for number of units. You may get some, like if you've got 5 properties that are 40 units each, that's 200 units in one market that one regional manager can handle, then you can get some consideration for that. Okay. So that's offsite. On-site, that's negotiable. On-site's going to be anywhere from 3.5% to 5%, depending on what the NOI on the property is, what the rents are on the property. They're going to want a minimum number. So they'll either tell you, we're going to have, and they'll do the same thing offsite. We're going to either charge a minimum baseline of this based on your occupancy and your NOI. And then as we lease up, it will go down to this rate. Okay. And that's typically what they'll do, because they know what they have to operate, to maintain their company. They've got payroll to pay just like everybody else does. Okay. Maintenance. If it's off-site, if the maintenance man has to go to the property, is there a trip charge for that? It better be included in the 10%. If it's an emergency call outside of working hours, there's going to be a trip charge for that. Be willing to pay it, but you're going to have to negotiate that number. Also, within the management agreement, you're going to want to set a number that the management company does not have to call ownership for. So for me, on larger properties, it was anything under $500. The management company had authority over making decisions. Anything greater than $500, they had to reach ownership. You just have to figure out what that's going to be between you and your partners. Same thing with leasing. How are we paying the leasing agent? Is the leasing agent getting a percentage of what was leased? Are they getting the deposit amount, which means you lose 1 month rent because that deposit goes into an escrow account? It doesn't belong to you. It belongs to the resident. Until that resident has forfeited that deposit, that is the resident's money, not yours, which is why it sits in a separate account. So if you're giving them the monthly deposit as a leasing commission for, which is what like a real estate agent would charge, then you're losing 1 month rent. That is a concession that you have to account for. Vendors and contractors. Okay. The big thing here is the term. And if you sell the property, does the contract run with the sale of the property? There's a laundry company out there called CoinMac. They have one of the hardest contracts to get out of that I have ever seen. So when you purchase a property and CoinMac is the laundry room vendor, you need to negotiate with CoinMac and the owner to get out of that contract prior to closing on the deal, because if you just close on the property and think you're going to do it later, you're toast. Their freaking contracts are ironclad. Okay, so you got to be careful of that. And then what incentives? Again, incentivize renewals, incentivize lease ups on renovations, incentivize lease ups on new construction. You can incentivize maintenance by the amount of tickets that are on the board over a period of a month. Like if when you take over the property, if maintenance was averaging 15 tickets on a daily basis, over a month, then if that maintenance person can get it down to 5 and all the residents are smiling, incentivize them for it. Or for no capital expenses over a 12-month period, which means that maintenance person is doing their preventative maintenance. Okay, so if there's no capital expenses for an entire 12-month period, make sure they get a good Christmas bonus. Right? Interviewing on-site personnel, you want to look at the manager's experience, their business plan, their retention strategy, their leasing strategy, certifications, and compensation. And we've covered all of this already. For maintenance, you want to look at their experience. You want their preventative maintenance plan. What license and certificates do they have? In some states, if they're going to be charging the HVAC units, they're required to have an HVAC contractor's license. What compensation are they getting? For leasing personnel, what's their experience? What's their leasing plan, both online, offline? And what is their tenant retention plan and their compensation structure? And we've covered all of this. Okay. Any questions about hiring management? Sorry that took so stinking long. I still got 51 of you. We're already 5 minutes over, and we still got to get through a whole nother section. All right. Thank you, Andrew. All right. Let's keep going. Oh, let's see if we can get through getting the money in 30 minutes so we got time for Q&A at the end. Don't count on it, though. My track record isn't so good today. All right. So getting the money. How are we going to get the money in order to close on this deal that's been presented to us? First, you have to understand you're not pitching anything. You're offering an opportunity. Yeah, George, just email me. I'll send it to you. I hate the term pitch deck. I do not call it a pitch deck in my world. I call it an offering summary. Okay, we're talking about raising capital from passive investors. Okay. It is an offering summary, not a pitch deck. Pitching, you're selling something to somebody. You're not selling anything. You're offering an opportunity. Make sure you change your mind so that that computes. All right, the strategic acquisition system. We've got lead generation. Okay, this is how we find and attract and prospect to passive investors, whoever that target market may be. You've got to identify what market segment. Now, if they can be similar to you, the better off you are. So if you're a doctor, I would be going after doctors. We know that most doctors are accredited investors. Okay. If you're an attorney, why wouldn't you market to attorneys? If you're an engineer, some engineers are accredited, some are not. Okay. You guys getting my drift here. If you're a car mechanic, you should not be targeting doctors. You're just not going to relate. Doesn't work. Okay. Unless your wife's a doctor. But if you're an RN, then you do relate to doctors. Or if you're a physician's assistant, you relate to doctors. If you are an hospital administrator, you relate to doctors. And I'm just using doctors as an example because everybody seems to think that they should target doctors for passive investment. Well, I got news for you. They don't talk to you unless they relate to you. They just don't. So figure out who you are. Now, me, I was in the aviation industry. So if I were out targeting passive investors or accredited investor, I'd go after aircraft owners. I relate to them. I speak their language. Okay. So you just got to think about what it is, whether it's hobby, whether it's vocation. However, who are you targeting for your passive investment? Okay. Well, the strategic acquisition starts with lead generation. We've got to get them into our CRM, into our ecosystem. So we're attracting investor leads into our database. All right. Now, once they're in our database, this is where Acquisition Pro takes over. Now we're talking lead conversion. There's 3 stages to every business. lead generation, lead conversion, and product or service delivery. Okay, when we're talking about passive investors, lead generation, lead conversion, and then we start talking about investor relations. All right, those are the three pillars to any business. So once we attract the lead, now we have to start working them towards qualifying and converting them into soft commitments. We can do this on an automated basis where we are only having conversation. Now, make no mistake, it's not fully automated where they're signing a subscription agreement without ever having a conversation with you. That's not going to happen. Don't ever expect it to happen. They're going to want to have a conversation with you. So we have to qualify and convert our leads into soft commitments. We can qualify through automations so that we are only having conversations with people that want to do business with us or that are at least interested in what we are offering. And that is what Acquisition Pro does. Investor relations, we will cover tomorrow. So after you get that soft commitment, you get the subscription agreement, you get the money in the bank, you put the money into the deal. Now we have to maintain investor relations so that they are not only happy for this investment, but they are happy for future investments that you may have as well. Okay. So we got to maintain that trust through communication. So let's start with leveraging LinkedIn. Okay. Lead generation. LinkedIn is used for outreach. It's prospecting. Okay. Prospecting is outreach. LinkedIn is perfect for automating your outreach. And you're like, well, wait a minute. How in the hell do you automate outreach on LinkedIn? Well, stay tuned. There's a tool for that. So first you got to personalize your profile, your personal profile. You got to optimize it for business. Don't personalize it. Your profile, you need to optimize it for your business. All right. So if you are a nurse or you are a physician's assistant or you are a hospital administrator, I would have all that stuff on your LinkedIn profile, but I would also have your real estate investing business on there as well. That is one of the occasions where I would combine both because you're giving yourself that credibility to be able to have that conversation with that doctor. Okay. Same thing if you're in the aviation industry or if you're an engineer or all these other industries that we talked about. All right. So you want to optimize it for your business. All right. Then you can create a business page. Now, if you're going to advertise on LinkedIn, and I would recommend testing it. Okay. There are ways to advertise that can keep your costs down. You're going to have a business page, much like you have to have a business page on Facebook to run ads on Facebook. You need the same thing on LinkedIn. You have to have a business page. Optimize it for your brand. It's too easy not to do it. Okay. Then you've got LinkedIn Navigator. So LinkedIn has three plans. You've got the free plan, and the free plan will allow you to search for prospects, but they're very limited on what you can see. So you may only see 30 results when you search under the free plan, even though there might be 3,000 results. You're only going to get to see 30. Okay. Then there's LinkedIn Pro. LinkedIn Pro removes that limitation. So now you are seeing all 3,000. And then there's Navigator. And Navigator is the prospecting tool within LinkedIn. Last time I looked, LinkedIn Pro was $59 a month and Navigator was $79 a month. Spend the extra $20 because within Navigator, now we can have better search parameters. We can actually use Navigator as a CRM, although we really don't want to. And we can segment our leads through lists. And that's going to become very important because I'm going to recommend you get a tool called Linked Helper. Linked Helper will do all of your outbound prospecting for you on LinkedIn, including connecting with the prospect. So Linked Helper will scan profiles that you give it a list for. That's why that list is so important in Navigator. You tell Linked Helper, I want you to scrape this list within Navigator. They'll pull all those profiles, And then you say, now I want you to connect with all the second and third contacts in those profiles. I want you to utilize this note when you connect. And then after they connect, I want you to send them this value proposition. And then you can even send follow-up messages beyond that. But those first two things are the most important. And all you have to do is turn the software on in the morning and turn it off in the afternoon. And LinkedIn does all your prospecting for you automatically, or Linked Helper does it all for you automatically. They have it's just linkedhelper.com. They do have a 30-day free trial, so you cannot go wrong with it. It is very easy to set up and use, okay? If you're not using it, you're making a huge mistake, especially if you still have a W-2, because Linked Helper can be working all day on your LinkedIn prospecting while you're working your W-2. So this automates our prospecting efforts, and it is easy to set up, and it acts like a human. So LinkedIn cannot tell it's a bot because it only does one prospect, one profile at a time. All right. Highly, highly, highly recommend Linked Helper, linkedhelper.com. Susan, I don't know what the heck you're talking about. I'm not advertising anything. All right. So here are my numbers from my LinkedIn efforts using Linked Helper. So I had 2,978 connection attempts, 1,208 accepted a connection, and I was targeting multifamily, and I was targeting real estate investors. No, that's it. I was targeting real estate investors for this one. 1,208 accepted the connection, so a 40.1% acceptance. 231 responded via direct message, so I held conversations with 231. 3.9% click through on the link in the first message, so I had a link to get them into my CRM in the first message. And I had an 11.1% opt-in rate, meaning of the ones that clicked through and saw the landing page, 11.1% gave me their contact information for the bribe I gave them. Okay. So LinkedIn was solely responsible for me holding 350 plus Zoom meetings from February 2021 to August 2021. 8 months, 350 meetings. Crazy. Okay. Leverage LinkedIn. Use Linked Helper. Okay. I do not get paid for you to use a Linked Helper. All right. Just go to linkedhelper.com. That's not my service. It's a third party. I use it. It's amazing. All right. Facebook. Still in lead generation. Facebook is used for building your presence. LinkedIn is used for outbound prospecting. Okay. So we're outbound marketing to LinkedIn. We're doing inbound marketing from Facebook. We're leveraging our presence so that they are reaching out to us, right? So you want to optimize your personal profile for business. If you guys look at my personal profile, you wouldn't even know I was a human being. You would think I was an entity, okay? And I like it that way. Every once in a while, like we just had Mardi Gras, my wife posted some pictures from our ball and a couple other things, and my son just had his 21st birthday yesterday. I posted a couple of things from that. When I was really active with my hot rod's been broke for a while. I've got to finish rewiring it. Just got the motor back in it. I was posting some pictures of my hot rod. Other than that, you'd never know I was a human being. It is all optimized for business. Create a business page. I don't like Facebook, but I think not can be useful. Well, Dias, it is absolutely necessary for multifamily because your target market's on Facebook. Maybe not for capital raising, depends on who you're capital raising from, or who your target market is for capital raising, but like owners and sponsors and syndicators and other people that are in our industry, they are on Facebook. You're making a huge mistake if you're not utilizing Facebook for your multifamily business. For George, for office, complete opposite. I don't think anybody in the office ownership industry is on Facebook. I think they're all on LinkedIn. Okay, so you need a business page if you're going to, if you are going to advertise on Facebook, you have to have a business page. I literally just created a business page, I don't know, last week sometime, a few days ago, for Acquisition Pro. And it's been growing. My intent with it is eventually I'm going to start advertising. Well, my daughter, because I've been banned from advertising on Facebook. They really hate me for no reason, but you know, there's that. So that's why I have a business page. If you're not going to advertise, don't waste your time with a business page. You don't need it. You're going to want a Facebook group, because you cannot create community from a business page, but you can create community from a Facebook group. And that is where you'll build the largest presence, is with your Facebook group. Okay. Now, there is another tool. And again, I'm not getting paid for this, that I want you guys to understand. It's called GroupKit. It is a Google Chrome extension. I think you can get an annual subscription. So an annual subscription with Linked Helper was like $297. Well worth it. You can purchase monthly, you can purchase quarterly, or you can purchase annually with Linked Helper. With GroupKit, you can purchase monthly or you can purchase annually. If you purchase annually, you get like 4 months free. Okay, it's insane how affordable GroupKit is, but here's what it does. When somebody requests to join your group, you have the ability to ask questions. If one of those questions is, what is your email address? And the way I put it is, we're constantly providing real estate education to multifamily investors. Would you be interested in us emailing you opportunities when these education opportunities come up? If so, what is your email address? We get about 80% of people will put their email address in. First question is, what is your biggest fear about investing in multifamily? And the last question we have, because you only get 3 questions, is, can we contact you via direct message if we feel you're a fit for some of our programs? Something like that. I can't remember what the exact questions are. The key is that email address, because what GroupKit does is it's a Google Chrome extension. And when it's turned on, you get your approve button changes colors and gets bigger, so that when you approve somebody, GroupKit is then connected to your CRM. Now, that means that they are connected directly through an API to Acquisition Pro. So if you're utilizing Acquisition Pro, when somebody asks to join your group and they put their email address in that box and you hit approve, GroupKit sends that lead, their name and their email, to and the answers to the questions, to Acquisition Pro. So you just automatically put these people in your database. I'm getting about an 80% conversion on that. Okay. I still have to try to convert the other 20% through other means. So this automates your lead generation efforts on Facebook. I can't tell you how powerful that is. All right. I spent years trying to figure out, how do I get my leads out of Facebook and into my CRM on an automated basis rather than manually entering things. Well, when GroupKit came along, it fixed that. Okay. It's easy to set up and it adds contacts directly to your group and your CRM. So about 80+% of my members in my Facebook group are on my CRM from GroupKit. And I've got 4,500 plus members in my group, and 80% of those members are in my email database. That means there's 3 types of traffic. A guy named Russell Brunson owns ClickFunnels. He coined this. There are 3 types of online traffic. There's traffic you buy: Facebook ads, Google ads, YouTube ads, LinkedIn ads, Twitter ads, TikTok ads. That's traffic you buy. There's traffic you earn. That's your Facebook group, your personal profile followers, your friends, your LinkedIn connections. That's your traffic you earn. And then there's traffic you control. The only traffic you control is your email database. Facebook can shut my profile down at any time. They can close my group at any time. LinkedIn can do the same thing. YouTube can do the same thing. TikTok can do the same thing. You don't control. Matter of fact, you can't even control what the people in your group see. Even if you use that at everyone tag that everybody hates, they still don't show it to even a minor portion of everybody in your group. So the only way to control the traffic, meaning the message that you're getting in front of your prospect, is through your email list, which is getting them out of Facebook and onto your email list, into your CRM. Okay. So the remaining 20% are enticed with free masterclass registrations, free meetup registration, download a free tool, free checklist, things like that. Okay. So you must provide value and not just hit your members with call to actions. That's a mistake I made. If you were in my Facebook group, I'm pretty much call to action, call to action, call to action, call to action. Every once in a while, I throw some value in there, but for the most part, it's always been call to action. That was an error. I should not have done it that way. I should have built that group where I created more community, got more goodwill, and it would have been a much better group than it currently is. Still a good group, but it's not a great group. It could be a great group if I would have provided more value than asking for something. And I didn't do it that way. So don't be like I did it. Do as I say, not as I do in that case. All right. Leverage other Facebook groups. Create valuable posts, answer and ask questions on other people's Facebook groups. Show your expertise and build trust. Connect with your target market. Again, who is the target market that you're going after for accredited investors? Can you invite them to your Facebook group? Now, the only way to invite people to your group is if they are a friend on Facebook. So you can, as you're commenting or they engage in a post you make or a comment you make, you can send a friend request to them, and you have a better chance of them accepting or not. You can only invite friends to your group. Now, if you do that, you're bypassing GroupKit. So you need to be aware of that. So if you're using GroupKit to move them to your CRM, if you invite, they automatically come in. They do not have to answer the questions. So it bypasses GroupKit in that case. You can DM them for building deeper relationships. Do not cold DM people from LinkedIn, from Facebook, from Instagram. Doesn't matter. Do not cold DM people. You'll lose all respect with them. Get connected with them first, and then you can send a DM. Either try to build a relationship first or start off with a value proposition. In LinkedIn, it's okay to start off with a value proposition. Facebook, maybe you want to build a little more conversation first. Okay. Do not send cold DMs. Then we have so that's lead generation. Any question about lead generation? All right. Lead conversion. Components needed. So inside Acquisition Pro, you get landing pages and websites. We talked about this yesterday. There are lead capture forms that you can put on the landing pages. So if you're in LinkedIn and you have a link in your linked helper value proposition, that sends the prospect, if they click on it, to a landing page. You need to have a lead capture form on your landing page, which then adds them to your CRM. More importantly, it puts them into an opportunity pipeline automatically through automation workflows and automation tags and triggers. All of this is all done automatically inside of Acquisition Pro, and you now have them on your list, and you can segment your lists inside of Acquisition Pro based on what tags that they have. So I segmented a list for somebody one time that wanted passive investors, which just meant it's initial coming in. So if they clicked on that smart list, all the passive investors that had the passive investor tag were in that list. Next, they had non-accredited investors. So those investors in the passive investor list had filled out an investor questionnaire, and they determined that they were non-accredited investors. And so then they were tagged with non-accredited investor and were put in the non-accredited investor list. If they filled out the investor questionnaire and they were accredited, then they were put in the accredited investor list, smart list. So they were tagged accredited investor. Now, there's one more that you need. Okay. So we know we can have 35 non-accredited investors on a 506B. But what do you also have to have? You have to have a relationship. So once a certain amount of communications occur, a tag is automatically added to the prospect called qualified investor. So if they are in the qualified investor list, that means that those investors in that list were qualified for 506B. So that was your 506B list, and your accredited investors were your 506C list, because accredited investors, you still had to have a relationship with them before they could be qualified, whether they're accredited or not in a 506B. So that's how I segmented that out. And that's all done automatically inside Acquisition Pro. And then we have a newsletter template, because you guys like to send newsletters. I don't get it. Nobody reads them, but you love to send them. So I built one, so it's there. Okay. So in order to get them to agree to fill out a questionnaire or to a soft commitment, we have to have something we're offering them. We need to get them to schedule an appointment with us. That's the whole purpose. We get them in our CRM. Now we have to schedule an appointment with them. Okay. So we got to have something to offer. Well, it can be strategy specific. Okay. You don't have to have an offering right off the bat. You can be looking for accredited investors or qualified investors before you ever have a deal. Okay. So initially, maybe you want to be strategy specific, or maybe even market specific before you ever get a property specific offering. So what is strategy specific? Well, what's your strategy? Are you looking for value add? Are you opportunistic? Are you looking for cash flow? Are you doing ground up development? What strategy are you using? Are they conventional apartments, low income, senior, student, combination of one or two of them? Although I wouldn't recommend combination, but people do that. Okay, that's strategy specific. You can create an offering summary based on this information to start having conversations with passive investors. Maybe you want market specific. You can combine strategy specific and market specific and make it even more powerful. So now we're talking about a specific metro statistical area or a combination of metro statistical areas, maybe even a region or just a local market. And then there's property specific. This is 123 Main Street, anywhere USA. Okay. We got to have something to offer. They're not going to talk to you if you don't have anything to offer. So you have to build this out, figure out what this is going to be, create your offering summary so that when you're having that conversation with the prospect, with that passive investor, then they can start to ask their questions about your specific strategy, your specific market, or that specific property. But you got to position yourself. So how do we do this? Well, we can use the team, because a lot of people say, well, wait a minute. I don't know what markets. I don't have a strategy. I'm just getting started. I've never done a deal before. How in the world are these people going to talk to me? You got to leverage a team. Start putting a team. If you're going to do syndication, I don't personally recommend syndication, but if you're going to do syndication, you got to put a team in place. Okay. This can be partners. This could be strategic partners, operating partners. If you find that operating partner or a management company that you've interviewed and you like that management company, ask them, can I put you on my offering summary as an operating partner? Right? You find other syndicators that are willing to partner with you on a co-sponsoring basis. Ask that team, can I use you on my offering summary? Now you're leveraging their experience, their qualifications on your offering summary. Okay, you're looking at their experience, you and or your team, and then outside relationships. These are lenders, brokers, management company, that operating partner, legal and financial. Okay, list these all on your offering summary. Okay. Do you have the capacity to execute? If you don't, leverage your partners. Okay. This is closing deals, gone full cycle, or even been through a full market cycle. Of all the syndication companies that you guys see every day talking on Facebook and standing in front of their jets and in their boats and traveling and doing all this stuff, how many of them do you think have been through a full market cycle? Very few. Agreed, Thias. Very few. Okay. Most of them have not. Okay. That's a big deal. If you've been through a full market cycle, that's a big deal because now you survived a market cycle. Okay. Most of these people that are in the syndication world from the Southeast, they aren't going to survive this market cycle. Okay. They'll be out. Gives you the opportunity to be in. All right. So why you? Well, I know this says why you, but we need to qualify them. We're qualifying them as much as they're qualifying us. Okay, George. Thanks, buddy. So initially, when we're having this conversation, we want to ask them about their background. Okay. How busy are they? That's an indicator. That's a motivation factor. If they're a busy engineer or a busy doctor, they don't have time to research and invest in properties on their own. This is qualifying them. This starts to say these are good prospects for us offering opportunity to them. Ask about their investing in personal goals. Okay. If you don't ask this question, they probably aren't going to have a conversation with you. If you're just offering an opportunity, the first thing they're going to come to is, why is this guy offering me something doesn't even know what I want? You got to find out what they want first. It's all part of qualifying. All right. And then be ready to answer their questions. And that comes with that 49 questions investors ask, which I said it came from the best ever syndication book. I removed a few. I added a few. Best list I've ever seen. I love Joe. Joe's a good guy. Joe does the right thing. If there was ever a guru I would recommend in the marketplace, but he doesn't really teach or coach anymore, I would recommend Joe Fairless. I think he's done the right thing. He's one of the few. And then, of course, the download for VIP, I've already sent it to you. It says in the resources, but I already emailed it to you. Thias, it's the best ever syndication book by Joe Fairless. So it's the best book ever, and it's the biggest book. It's like 480 something pages. It's the best book ever written on how to do a syndication, but it's just how to do a syndication. If you're going to read that book, then you need to read Gene Trowbridge, his book, It's a Whole New Business, 4th edition. Joe's book will show you how to do a syndication. Gene's book will show you how to stay out of jail. Because make no mistake, you screw up, you could go to jail. So Gene shows you the legal way to do it. Joe's book shows you tactically how to do it. I hope that makes sense. All right. What are your action steps? Woo, we made it through it. 37 minutes late. Download the due diligence checklist and make it your own. Again, for the VIPs, I've already sent it to you. Download the property management questionnaire, already sent to you. Download the YU questionnaire, already sent to you. Build out your investor workflows and pipeline in Acquisition Pro. So for the VIPs, you guys all got 30-day free trials to Acquisition Pro. Don't do this yet. Wait on this. Let's wait till Thursday. We're going to talk about some onboarding and exactly how you need to take care of that. Build your presence in Facebook. Get Linked Helper and automate your LinkedIn prospecting. I'd even add build your presence in Facebook and use GroupKit to automate getting the leads into your CRM, whether it's Acquisition Pro or any other CRM. And then send potential investors to your landing page and let Acquisition Pro do all the work for you. Woo! We made it through it. Sorry, guys. I know that was long. How many do we have left? And we still got 46. So we lost about, well, not quite 10. That's not too bad. All right. So look, Acquisition Pro. The VIPs, you guys have all got your account set up. If you did not fill out the form, I did not churn your account on. I need that information on that form to churn on your account that you got in your email. Oh, and Susan wants the last slide again. Your off-market workflow is already in the account, and your passive investor workflow is already in the account along with those pipelines. That is a basic way to start with Acquisition Pro. Now, there's some connections and some other things you're going to have to do. You're going to have to get your DNS settings for your email. You're going to have to get a phone number. You're going to have to do your A2P and all the rest of that stuff. Okay. That is not the fully automated system. The fully automated system is the strategic acquisition system, where when somebody comes in or you give them a tag, it takes them step by step through this fully automated process. You don't have to touch anything. With the current system I've put in your thing right now, your emails, your SMS follow-ups, those are all there that I've written, but you have to manually move the prospect through the pipeline. Okay. Okay, roger that, SK. So the strategic acquisition system is available, and it is a done for you system. I build it for you. I set up your phone number. I set up your DNS settings. I host your account for you. You just have to buy the domain name. I do everything for you. I build out all your workflows, customized specific to your business. Maybe you don't want to do passive investing. We do it just for off-market opportunities. Maybe you want to do both. Maybe you just want a capital raise. So I customize it directly for your business, and it literally churns into this tool that allows you to just have conversations with people that want to do business with you so that you do not have to worry about the tech. I take care of all of that. All right. If that is something you're interested in, send me an email. I'll send you a calendar invite and let's have a conversation about it. All right. That's all I'm going to say about that. But I do want to let you guys know that I do include the fully automated package, and I build it for you and do all the connections for you. So all you're doing is holding conversations. Just send me an email. I'll send you a calendar invite. We'll have a conversation. What questions you guys have? All right. Mel, David, what if you're already on GHL framework with another coach here in Canada? Can there still be some value? Yeah. So all you have to do, Mel, would be to give me admin access to your account, and I can build the strategic acquisition system right into yours. And because I wouldn't have to host your account because you're already using somebody else's, then I can give you a reduced price for it. Hope that answers your question. No worries. Send me an email. We can talk about it on a call. Yeah, Damien. Let me see. Oh, the recordings are on YouTube, guys. You get the recordings. You just don't get the documents. You don't get VIP day. If you're not VIP, you don't get the 30-day trial or anything like that. But the recordings themselves are on YouTube. I've already got the first session. I emailed you, Damien, on that. All right, I'm going to stop the recording here so we don't have all this question and answer period in the recording. So I'm just going to stop recording right now if you guys don't mind.